And let's talk about what's happening, because this is good money. This is real money. This has demand in every single aspect and every single area of the global economy. What do you have here? Lots of downgrades, don't you? That you can't even use these as a tool of barter anymore. So is that where the US dollar is headed? Yep, it absolutely 100% is.
Lynette Zang, the Chief Market Analyst at ITM Trading, has been a prominent figure in the financial industry. In the latest video, she highlights gold and silver's value as real money in demand, predicting a notable US dollar decline from its lost world reserve status. The US dollar drifted lower on Wednesday in thin range-bound trading, with investors looking ahead to Thursday's US consumer prices report for indications on where the Federal Reserve's monetary policy is headed. Buying gold on rallies has caused more than a bit of indigestion for investors. In 1980, 2011, 2020, 2022, and 2023, gold reached record highs and experienced significant price corrections. Therefore, buying on new highs has been a dangerous approach to the gold market. Lynette highlights gold and silver's stability as a historically proven store of value, contrasting their security with the volatility of fiat currencies. Gold prices continue to cling to support around $1,950 an ounce as it struggles to attract bullish investor attention. However, one market strategist said that the precious metal remains well positioned to take advantage of the US dollar's waning reserve currency status. As per Lynette, safe haven metals are rising due to an unexpected US government debt downgrade by a key credit rating agency, creating market uncertainty. Rating agency Fitch on Tuesday, August 2nd, downgraded the U.S. government's top credit rating, a move that drew an angry response from the White House and surprised investors, coming despite the resolution of the debt ceiling crisis 2 months ago. Traders' immediate response was to embark on a safe haven push out of stocks and into government bonds and the dollar. While talking about Fitch rating, Jamie Dimon dismissed the downgrade. Lynette noted Warren Buffett's unconcern, citing that these individuals hold larger quantities of assets. She urged financial autonomy away from central bank control by holding gold and silver. The Fitch Ratings downgrade of the United States long-term credit rating ultimately doesn't matter, J.P. Morgan Chase CEO Jamie Dimon told CNBC on Wednesday. Still, it's ridiculous that other countries have higher credit ratings than the U.S. when they depend on the stability created by the U.S. and its military, Dimon added. Warren Buffett is shrugging off Fitch Ratings' historic downgrade of U.S. credit from the top AAA grade to AA+. We will now bring you clips of Lynette from her recent video. Before we proceed further in this video, please make sure to subscribe our channel and click the bell icon to stay updated.
The U.S. is still classified as the world reserve currency, which means that if you are a government, a corporation, or a citizen going outside of your borders to buy anything, you had to do it with US dollars. Now that's no longer true, so that puts us at even greater jeopardy. But Fitch Ratings has downgraded the United States government's credit rating, citing rising debt at the federal, state, and local levels, and a steady deterioration in standards of government over the past 2 decades. Count them. Of course, they want us to believe that it doesn't matter. Don't you remember when we were taught, the debt doesn't really matter? And we kept going after that. So, hey, maybe this credit rating doesn't really matter, and we can just keep going along as we are. Well, I think it does matter. I think it matters a lot. But J.P. Morgan, Jamie Dimon, calls this downgrade ridiculous. It doesn't really matter. After all, the markets determine that. Warren Buffett says he's not worried about the U.S. downgrade. Watch, he'll just keep buying more 10-year Treasury bonds. Of course, both of these entities and people have a whole lot more of this crap than you and I do. Plus, they're in the team that's been chosen to win. Because remember, as George Carlin says, this is a big club, and you and I are not in it. We need to create our own club and vote with our wallets. Because if you vote with staying in the fiat system, then you're being ruled by these guys and the central banks and so much more. Now, I will say that having them come out and saying that it doesn't matter, that it's ridiculous, makes me feel so much better, especially since that's what backs this. And I hope you realize I'm being completely facetious because I know the truth. You got to have this for your foundation to protect whatever you have in the fiat money system and to put you in a position to not just survive this, but even thrive through it. So on the other side of it, you're in a much better position. You are not, you own nothing and are miserable.
The value of the balance sheet of the Federal Reserve increased significantly overall since 2007, when it stood at roughly $0.9 trillion US. As of July 26, 2023, the Federal Reserve had roughly $8.24 trillion US of assets on its balance sheet. The most dramatic increases took place in 2008 and in the first half of 2020. During the interview, Lynette noted Fed's expanded balance sheet since 2008 highlighted decreased Treasury replacements and its buyer impact. She also addressed currency values and their false purchasing power revival. The rising dollar has kept gold bearish, with the spot price of the yellow metal trading below significant moving averages across the daily and weekly time frames. Despite the dollar's strength, gold is holding nicely compared to other commodities market analysts hold. Let's get back to interview.
This is savings. This is debt. I like this. In gold and silver in my possession, I trust. And this is the Fed's balance sheet, presuming you believe them. And you can see this is January 2018, because prior to 2008, we're at 800 billion. Now we are still above 8 trillion just in that little period of time. But they are not replacing the maturing bonds. So you can see this decline right there. So if the Fed, who's been buying a ton of treasuries, is no longer buying the treasuries, and you see this attempt to run it off and then boop, and now we've got another attempt. We'll see how long this goes. Normalization, what's normal? We've been in extraordinary measures forever. The Fed is shrinking its holdings of treasuries by up to $60 billion a month by letting securities mature without replacing them. So I'm thinking a lot of this debt is going to have to be absorbed by pension plans and retirement plans and institutional investors, because this removes a key buyer of treasuries. That's not a good thing. But Fed officials tout job market slowdown, seek to pivot from hikes. Yeah, they want to lower rates because the corporate debt, the government debt, this is a huge debt bubble that is already popping. So rather than try to reflate it, they're trying to let it go down slowly. Is that going to happen? Well, if history is any indicator, I would say no, because here's a whole bunch of currencies that have absolutely zero market value. You can't barter with them. Maybe they have a little bit of collectible value, and people think, well, I bought a whole bunch of these Iraqi dinars and they're going to make this good again. No, that's what they knew when they set up this system. And they said, people cannot but hope that their currency will regain some of its purchasing power, but it never does because the design is for it not to. Debate to shift from how high to hike to how long to hold. Yeah, but don't worry, because they're coming out and saying, yeah, I think the Fed can pivot. I think we don't have to raise rates anymore. Yeah, because the system is flipping, falling apart. Do they need to pivot to control interest rates and support this bond market? Do they need to pivot so that the Treasury can issue tons more debt? You really have to look at this. They want you to think that the levels of debt don't matter. They want you to think that the rising interest rates can still engineer a soft landing. It's garbage. We need as many people as possible to take off those rose-colored glasses, see what's really happening so that you can make educated choices that put your best interest first. Because financial shields, they're made of physical metal, gold and silver. Definitely not paper or promises, because those are just lies.
Since gold is the world's longest standing asset, with its history as a hard currency spanning thousands of years, buying gold during periods of price weakness has been the optimal approach to diversifying portfolios. In a world of economic flux, where do you see the future trajectory of gold and silver? Share your thoughts in comments section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.